Hello guys, let's see if we are live. Hello guys, as usual, this is our 40 session live stream, and in this video or in this session we try to speak about the stock market crash. Okay, all the people speak about it. It's not from today or from this year 2018, but 2017, 16, 15, or any other year. Okay, the reason why the people or investors are always asking about hello Muhammad bin Abba, how are you? It's very good. So, as I told you, the subject of today is so important to everyone, okay? Especially investors, those people who get the most hit. And I will show you during this presentation some problems of these crashes, and when they come, what do they do, and who will be the biggest losers, and who benefit from this crash. Because the people, a lot of people, they think that when say stock market crash, they begin to think that it is a disaster for everybody. No, it is not for everybody. It is for the public, mostly the public. Okay, the public, it means us, all the people who invest and hold for a long time, and they don't know what to do in these cases. Okay, and this is the most problematic thing in the stock market crash. Okay, so I'm just trying to just give you an idea, and then when we have a lot of guys, I will be happy to explain to you more and more about this stock market crash and solutions. Okay, some solutions are very hard to do. Okay, and sometimes the problem, I'm telling you right now, that you get trapped into some investment that you can't get rid of, and this is one of the most destructive things about the crash. Okay, you have an investment, but you can't get rid of it. Okay, so here I'm speaking about those plans like a 401k or any other form that you can't get your money until you are 59 6 months. This is what I'm talking about, those investments that they have rules, and when the stock market is going down, you want to take all your money out. Let's say you have 200,000 or you have 300,000 or $500,000, whatever, but you want to take this out, or you want to find an alternative to your money investment. And at that time, there will be like chaos in the stock market. Things are going down each day, each week, and you will never know when these things stop. Okay, and you see that your for investing, I'm talking right now about investing, and then I go to trading. You see that your whole investment is disappearing. Hello Nasty Nanochi, how are you? Bonsoir, comment allez-vous? Okay, so you should have your cup of coffee or tea or soda, some water, and you stay with me until we finish with this subject. Okay, it will be like as usual 1 hour or 2 hours until we finish this. So when do you think this crash will happen? Some people each year, they say, you know, some guys, godless goddess, you are night owl. Yes. I am night owl, yes. I stay at night a lot. And you know, in America here and in Europe, you see, we are in different zones. Okay, in Europe right now, it is 5, like in France, it's 5 a.m. It's the early morning. Now, if you go to Asia, like Singapore and the other, it might be the afternoon. Now, here in America, I am in the east, in North Carolina. So, if you go to the west, it is still early. Okay, let's say it is now here it is 11, there it is 10 or 9 or 8. So like California, they have 8. So they are just early night. Okay, so it depends on where you live. Okay, I don't want to speak a lot without beginning with the thing. Oh, see, here we have another guy who is from Perth, from Australia. Okay, he should be like maybe in the afternoon of tomorrow. So he is normally he's in the past. We are in the future, because we are just 11 today, which is Saturday, but he is living in Sunday, and he is living in Perth. Oh, okay, there is another one from Hong Kong, and you see that we are not in the same time. He said, put debit spreads are good. Okay. I will just speak about whatever I know, and you guys, if you have more information, we can share the information. And Shmuel, he is in Israel, and it is 6 a.m. in the morning. It means we have 7 hours. 7 hours from here. So we are living in a small planet right now, and we can reach each other, and we communicate with each other, although we are so distant in place. Oh, someone is in Wisconsin. It's 10 o'clock. Okay, 10 o'clock is good. Some they are in 9. In California, they are in 8. Okay, so this is the time thing that we are speaking about. Now let's begin with the beginning. Now, why the people, they always speak about the crash, the stock market crash? Why? Because it happens frequently. Okay, after a few years of bull market, there should be what we call a correction. Correction, it means a lot of people, they sell. We try to go to that, and I will explain to you who are these people, because who can put down the stock market? There should be big guys. It's not me or you. You are selling a few shares, 100 shares, 1,000 shares, or 500, or even 10,000 shares of a stock. You will be making a mess in the stock market. No, you are not, and I am not. And small investors are not. So who are these people? We will speak about them right now. Mr. Marsh said, nice subject, sir, from Glendale, Arizona. Oh, that's good. I like Arizona, you know, there is a lot of gold there, so it's very good. So Dr. Ted said, they see the market going up. I have a call back spreads on, and they have done really well. They are my upside down hedges. Yes. Okay. We will see that. Goldman Sachs and the Fed. Yes. It means a lot of people. A lot of people are involved. I used to live in Why Godless Goddess. Oh, okay. Now in Texas. Okay. So, as I told you, the first question is, why the stock market crash? It means why the people are speaking, each time are speaking about stock market crash. Because through history, the people, they suffered a lot of stock market crashes. That's why they have this as something that it will happen. Even not today, it's not, maybe not next week or next month or next year. It will happen, it will happen. Okay? It is just something that it is part of the market, that it happens in some interval of years, but we don't know exactly when. Okay? So, let's go. I'm not going to the chart right now. So I'm going to just to explain this with the diagram. At least we will be okay. Please just someone said, Dr. Ted said it might even crash because people watch movies like The Big Short. Yes. Now I will speak about the crowd. These are called the crowd. The crowd, it means people who don't know what's going on and they just follow. This is when you hear the word crowd, it means the public who have no information, who have no knowledge, who don't know investing, who don't know trading. Although they trade and they invest, but they have no clear idea what's going on. So they trust some people online, TVs or gurus or someone who is very famous on TV. They just trust it blindly and they do what they ask them. And this is one of the biggest problems that I will speak after. Okay? Now, let's go to, please don't write in the chat room until I finish this. It could take me like 5 minutes or 10 minutes. I will explain this, why, and then after that we can go to the chart and then we'll show you some stock market crashes. At least you will understand. Okay? So, let's go to, okay, to explain. This is what you see. You see everything white. That's good that you see it. Okay. So, now this is the stock market is going up. As you can see, this green, many years. And then we have a small correction. Then the stock market continues, go up, and then it has a small correction. Then it goes up again, and then it goes down, and then we have the crash. So this is the crash. And what you see here in red, these two, just examples, are called corrections. Okay? Just, sorry for the handwriting. I should use the their writing stuff. It will be better. Now, what does it mean for you, correction? Correction is a lot of people, when they see that there are many years, let's say here, let's say we give you an example of the last big correction, which is in 2008. Just an example. 2008 was a very, very big correction. And for some people, it is like a crash. Okay? It's not only a small correction, but it goes down. So I will take this from here because you will understand it very well. Just to make the difference, the crash, we take an example of 2008. Okay, just to make sure you understand the difference. Now, the crash, it can take long. It means it's not 1 week or two. It will take the whole year. So this here from here to here, all this is 1 year in 2008. Okay? Now, how much the stock market lost in this stock market crash in 2008, which is called financial crisis? It lost nearly 50%. Okay? 50% of the investment in the stock market has been lost. Whatever you are, whatever you are. It means don't tell me that you are in drugs industry, or you are in some other. Almost all got a very big hit. I'm not saying 50% for everything, but every percent in general. Okay? Now, the correction, it doesn't stop very easily. It doesn't like this, 1 week or 2 or 3, it goes down very quick. Okay? Now, let's say I give you another correction that you know I have made videos about it, is the correction in 2016, when I think in June 24, I have made videos about this. And this small correction, it is only 2 days, on Friday and on Monday. Okay, 2 days only. But the market has lost a lot. But it is not the same as a crash. So this is just to make you the difference. A correction doesn't take that long. And then the people will buy again, and understand that here. On Tuesday, I have made video. So I have made video on Friday night, and Monday I make a video explaining this correction on time. It means if you go to my if you go to my channel on the June 24, and in 2016, you will find my videos on YouTube. You will find them. I explain everything, and I say it is a small correction. It's not a big correction. Why? Because on Tuesday, here on Tuesday, there is a big candlestick, and I say if it continues, it will be a very big bull. A very big bull here. Okay? Now, the stock market has been good for 2 years. It's a bull market. Everything is going up. Okay? But, oh no, I'm sorry. When I put 2016 here, no, here 2008. So this should be here, and this should be here. But I'm sorry. I will do a very quick change, just to make, because I was explaining what is a small correction, but I give you an example that it is after this 2008. Okay, let's do like this. Okay, just to make it the thing. Okay, here is the 2008. Okay, and the market is going up. Okay, and here is 2016. The example I give you. And now we are in 2018. Okay, just to make sure. So this is the crash, stock market crash of 2008. And this is here is the small correction of, okay, of 2016, I think in June 24th, because I still remember the day. So it is 2 days. This day is Friday, and then the second day here is Monday, and the good day, which is Tuesday, we have the green candlestick, and the stock market goes up into a bull market until now. So this is 2 years until 2018, where we are now. Now this 2008, this is the crash. So I told you that the market has lost 50% of its value. Even I know that some people, they love too much Warren Buffett, for example, Warren Buffett, which is Berkshire thing, BRK. I think it was 190, and it goes down to, I think, to 90,000. It means it's not just everybody. Even Warren Buffett, all his stocks go from 190 to 90,000. It means he has lost nearly 50% of his money. And if the market continues to go down, we will have more problems. But the good thing that the government has done a lot of things to stop the market going down like this. Okay, the government with the SEC, Security Exchange, they have done a lot of rules to some people to stop going that much. Okay, so this is the difference between a crash where the market loses a lot and a small correction. It can take only 2 days, like this one in 2016. This is called pre-exit news. I have made a lot of videos about this and explained it on time. It means on 2016 in June. I explained this very much time, and I explained when the stock is going up. I say if it goes up, you can go back to 2016 June 24 on my channel. You will find these videos about this small correction. Now this one, 2008, was called the financial crisis, where the banks suffer a lot, the retail, everybody suffers from this financial. A lot of jobs lost, millions of jobs lost, a lot of trouble. Okay, now let's go back. Let's go back right now. So let's see what the people have written. Okay, yes, it's very good that they have not written nothing. Hello, wise man. Okay, now since I explained what is the difference between small correction and the crash, we didn't answer. Hi, Baba Stock. We didn't answer the question, who is making this crash? Okay, it's just the big guys that they have or they hold the whole market. Mostly are mutual funds managers. Okay, so understand that these people, the whole market, it means 40 or 50% they own. It means they have all these stocks in their portfolio. So when they begin to sell, the market will be shaking because they have a lot to sell. Okay, they want to change their investment or something. No one will stop them, although the government has rules to stop all this stuff. Okay, to stop all this stuff, but still, the market will have a big hit. Now, Prince say good morning, Prince. How are you? Now, let's go right now. I will just show you the biggest crash in the United States of America. You know it all, and I will just give you just an idea. And then we can see other things about this crash. Okay, so let's go to the chart. Okay, so this is the chart, as you can see. Let's say we try to go to Dow Jones. Okay, now let's see, we go Dow Jones by year. Okay, so we go here. If you can see those 4 years, 1929, 30, 31, 32. This is what we call the big crash of 1929. It means the high of 1929 was 386.10. Okay, I will just write this information. So it was $386.10. This is the high, and it goes down to $40. Okay, 40. Yes, it goes to $40.32, $40.60, which is the lowest. Okay, this is the Dow Jones, the 30 stocks that we are always speaking about. Now, although you see here that it is very, very small, but the chart, I can't pull the chart from the beginning until 1932. Okay, that's why you see this which is so high here. So I'm not, I'm just giving you an idea. As you can see, this is 2008 that I have spoken about. It lost nearly 50%. And this is the crisis in 2000, 2001, 2002, 3 years, which is a very, very bad years. And then the stock market is going up and then it goes down. So let's go and speak about what did happen. Now, this is the Dow Jones. Dow Jones is just the index of the big companies in America. Okay, there are 30 stocks. They don't change that much, but mostly they are 30 big stocks companies by capitalization. It means they are so big, these companies. Okay, now this 386.10, it is in 1929. This is the high of 1929. This is the low of 1932. This is the lowest, the low of the year. Understand that why the people, they have a lot of trouble. If, for example, you own a stock that it is 386, just an example, okay? Because this is the index. Let's say you own a stock that it is 386 and you have 100k thousand or 200k thousand, 100k thousand, for example. Oh, let's make it easy for you to understand. Okay, let's you have in the bank, you have in the investment in those days. Okay, you have 386k. Just an example to make it clear. Let's say you have nearly more than quarter million. You are put in your investment. After 3 years, from 1929 to 1932, it becomes only 40,000. You see how much destruction is this crash. And after it, there is what we call the Great Depression, because the market cannot go back to what it was before, okay? Because there is a big destruction. A lot of companies, they go bankrupt. A lot of people, they lose their jobs. They lose their savings also. It's not, the problem is not only to lose your job, but to lose also the money that you save for your future. 386,000. After 3 years, you have 40. This is a real problem. Okay? This is the real problem I'm talking about. So, as I just explained for you guys, this is the beginning, just to make sure you understand very, very well the correction, the small correction, and the crash. Now, Baba Stock said, why Facebook doesn't gap up even good news? Oh, okay. This is a simple question. You see, Baba, the people who buys, they have another reason not to buy at that day, even if it is good news. Okay? Sometimes even it is bad news, but the stock doesn't go down, doesn't have a gap down. So in the stock market, try not to have confirmations and to have guarantees. This is the problem of almost all the people who are just try to understand the market, who are beginners. Okay? For me, in order to make money in the market, I have taken all this stuff that it is called guarantee. I know when I enter a stock, I buy a stock. I know that it could be going down and I lose money. It's always. So I protect myself with the stop loss. Okay? So there is no guarantee, and stop thinking that the market, that you can know the market with guarantee thing. Who tells you that if there is good news, the market will go up? Who tells you? So you are having an information that it is false at the beginning. And since you have an information that it is false, you want to apply it as a fact. This is not a fact. There is no fact in the stock market. You find the stock that it is $1, as he said, as Wiseman said, you find that it is $1. After 1 month, it goes to $30 or $40. And you see this company doesn't make any earnings. It's a small company. They do nothing, these guys in this company, but their stock goes from $1 to $40. So the market is illogical. So don't try to speak to someone who is a fool. It's like the market. The market can go up, can go down, and no one controls it because the participants are fools. They are illogical themselves because they are human. Okay? Who buys and who sells? I'm asking you the same question, the very simple question. Are they robots or are they human? The market will be human always, and if they tell you tomorrow that the stock market will crash, maybe you have all your stocks and you sell them. Although in Monday or Tuesday, the stock market doesn't fall. But you are selling your stock because of the information that it is false. Okay? So for us, we are not based our information on people. We are based our information on the price itself. If it moves up, we know that it's going up. If it moves down, we know that it's going down. Although other people, they say to you no. Okay, so this is just to make you understand, Baba Stock, that news, it doesn't mean that if it's going up, that it's going up. It means that you will be making money. Okay, and it could be up, it could be down. So if you want the risk, you should stay there. If you don't like the risk, don't trade the news. Okay, that's my answer to you. When you have a stock, your broker should tell you when there is earning news. For me, for example, I use E-Trade. I don't subscribe to anything, but if the stock is having an earning coming, like 1 week or two, it will pop out in that stock as a tab, and it says to me, okay, the earning news for this company is that day. Now, for me, I take this information and I will say to myself, am I going to stay or to leave? Most of the time, I stay. I don't care about going up or going down because I like the risk that I am in. Okay? So, Chris, hello, Chris. So, Chris says, why not just buy a momentum ETF? You will save on taxes and it will all happen automatically. Okay, Chris Johnson. First, the ETF, they are taking money from the ETF itself. It means there are fees. There is like, I think like 0.50 or 70 or $1, depending on these ETFs. They are automatic and they take money. It means that the price that you see, it is not the real price of the ETF. If you take all the stock, or let's say the ETF it tracks an index. Understand that the index, they are taking money from the index. So you are losing money. And then we have the ETF. there are fees, so you are losing money. So you are losing 2 or 3 or 4%, but you don't know that you are losing. That's why you see the ETF is going so slowly. So an ETF, it tracks an index. It doesn't track a stock. It tracks an index that it is a collection of stocks. Okay? So, and you say you will save on taxes if you are not making any money. What is this saving that you are? For me, I prefer to buy stock like Facebook. It goes from 1755 to 180, then to have an ETF that goes from 17, it goes to 25 after 5 years. Which one do you like? Because ETF, it goes slowly because it is just tracking an index. It's not stock. It cannot go so fast. Okay? So if you like ETFs and you like mutual funds, it means that you don't like risk. You want to be with the old people over 60. If Chris Johnson, I don't know your age, if you are 60 or more, you do ETFs, it's okay, because it is not a risky thing. Although there is risk, but it is not that much risk. Okay, like stocks. Yes, you can take that. And when you say automatically, what does it mean? If the ETF is going down, okay, you are losing money. Automatic or not automatic, it doesn't. Man, Chris, it's not a big deal. Okay, it's not a big deal with this ETF. Okay. Dr. Ted said taxes are not that important. Yes, they are not so important, because when you stay longer, like an investor, you stay many years, and then a crash comes and it takes all your profits. Okay, so where is this tax that you are benefiting from? I like tax because I am making money. I don't care about how much tax I pay. But the most important thing, I make money in the market. This is what we are here in the market. If you are doing investing, it is another thing. You get less in tax, but you are not going nowhere. Okay, this is what I am speaking about. Chris says you can buy momentum. No, yes, you can buy momentum ETFs that buy stocks like Facebook, yes, but the ETF doesn't have only Facebook. It has some losers that they were 100, now it is $2 with them. So these guys, some companies, they go bankrupt with this momentum ETF that you are talking about. And when we say momentum, who tells you that it is momentum ETFs? It means they go up and they. Who tells you this? Stocks, if you don't trade them, it is just what the market gives you. Where you are, what the market gives you. It's not something that you can rely on too much. So Wiseman said, don't fear Uncle Sam, Chris. Some traders, investors lose lots of profits from being afraid of having to pay taxes. Automatically, Chris suggests automatically in that it's buying and selling for you without any capital gains and taxes. That sounds like a crappy momentum. ETF Amtum is an example. So see, Chris, I'm telling you, how many ETF do we have? We have thousands of ETFs. Each day, the Wall Street, they create another ETF, because the Wall Street guys, when they make an ETF, a new ETF, they are making money from the ETF. But who bears the risk? It's the investors. And this is the problem. And you say it's automatic. Yes, it is automatic. But for me, I want to make money. I don't want to buy automatic thing. I want to buy something that can make me money, not automatic thing that can go down and I keep it and I hold it for long. Okay, and this is a problem. So Dr. Ted said, mostly likely there is a difference between whether you are a trader or investor. The ETF buying sounds more for investor and not trader. Yes, but you can buy ETFs when you trade, do swing trading. Yes, you can in a short moment when there is a trend. Okay, if there is a trend, yes, because the trend doesn't stay that long. But if you are investing, I will show you here just Dr. Ted and the other guy, which is Chris. I will just let you know. Yes, yes. Many financial products are marketing products in the financial field. Yes, it's always. Amtom buys stocks that are going up and sells when they are start to drop. Oh no, man, no. See. First, Amtom. I said, let me. 60, 13, 18, 5 years. So let's show you with a chart. Please check the chart. This is what you are speaking about, MTUM. This is the ETF for the momentum factor. Now, how many years this stays? It is 2013. 1, 2, 3, 4, 5, 6 years. 6 years, it was $60. It goes to 113. It means in 6 years, okay, in 6 years, it just doubled. Okay, now let's go to the to explain to you. So check here, please, Dr. Ted and Chris. Check with me here. I will just give you a hint what this is doing, because a lot of people, they don't know what's going on and they just get carried out with the thing. Now, this ETF, it was here 2013, now 2018, it's $113, an example, okay? And here it was, let's say it was 50 or 65 or 60 at the end of 13. Okay, let's say it's 60, and 60 by 60 is 120. Let's say it is, let's say you double your money. You have 100% money after how many years? Now you have 2013, 14, 15, 16, 17, and now it's 18. So let's say it is, you are getting mostly 20% each year. Okay? Now this is now. You will never know when this have a small correction, or no one knows. Okay? So it's not always that you base your investment on one thing. This is in terms of what we call, this is not diversified. Okay, although it has some mini stocks that are well known. Okay, some stocks collection, they see they are going good this time, but some of these stocks will be red when the market change for these stocks, and this, it will go down and you will lose. The more you continue, the more this can go down. Okay, if it goes and there is a big crash like this, so this 20% could be going to 10 or 7, and this is what all the market is going. Okay? So don't base all your investment on one thing and thinking that these people who are picking these stocks, they know the future of these stocks. Okay? Each stock is different. Each stock is belonging to an industry. Each sector is not the industry. For example, if you hold one of stocks of the energy sector before, okay, if you hold it for 1 year, you will be losing a lot of money from these stocks. Okay, this is just an example. Okay, so let's go and to see. Yes, that actually closes to 5 years. Yes, 5 years. I say it's 20% because from 60 to 113, it's like 20%. But these years they're very good. Okay, but any year that it is too bad, this 20% can change. Okay, can change, and giving your money to an ETF or mutual fund, this is a dangerous thing because you are not getting the best. Now, in these 5 years, if I tell you that Facebook, just an example, okay, I just give you an example. If you bought only Facebook, here you are making 20%. But how much money you make, for example, from Facebook? Just an example. Any stupid person who in 2012 or 13 buys by himself, not knowing anything about the market, okay? And let's say this example I give you, just an example, okay? It doesn't mean that you should buy Facebook now because it depends on the momentum. It depends on a lot of things, okay? So as you can see, Facebook here, the same thing, Facebook, which is a stock, now here. Now let's say today, let's say it is 180. It was 1755 in 2012, end of 2000. Now it's 2018. Now 6 years. So 6 years, how much this stock has gone? Let's say if it's $20. You bought it at $20. Now 500, 900%. This is what you get from Facebook if you bought it at $20. Okay? So do you see the difference between Facebook and this ETF? ETF, there are fees, man. There are fees. There are fees, and in ETF there are good stocks and there are bad stocks. Bad stocks because the guys who are doing ETF, they will not trade. It means at least they will hold this stock for 1 year. There are rules. Understand that ETF, they have rules. It's not like one guy who is a hedge fund who can buy and sell as he likes because there is no rules for him. By the government, by the SEC, there are no rules applying on him because he can even short sell stocks. In ETFs, okay, it tracks other things. Okay, it tracks an index, for example. Now this index has fees. Understand that it's 2% or 3% or whatever percent. It means it's taken from the price. Let's say they show you that the index is $100. Now the index in true, it is not $100. The true price is $103. But these three, they have been taken each year by these guys who are owning the mutual funds. So you understand why I'm saying that mutual funds and the ETFs, okay, they have fees and they are not as stocks. Stocks, we have more risk, but we have more money. How can you leave $900% and you go and you go for this 20%. How? Are you going to do 20% and you leave 900%? If 900% divided on 6 years, okay? Let's say you have, just an example, 120 or 130% each year. This is what you get. Let's say if this is what you get from this. So 100% is different from 20%, okay? So this is the difference between when you work with the stocks and when you work with indexes. Who makes money from indexes and from ETFs? It is the companies that make this index. They create this index. That's why, if I ask you right now, how many mutual funds and ETFs do you know? There are thousands. Each year they come up with a new ETFs because they play with stocks. They put stocks together in a collection. They give them a name, and they sell them to people. And they advertise for them that it is good and you can make money and so. But in general, they are not making that much money. That's why Warren Buffett has never bought indexes and ETFs. So if you can remember, Warren Buffett, as an example, Warren Buffett doesn't buy mutual funds. Okay, so why he doesn't he buy stocks, he buy companies, because companies can go up so good and he doesn't pay nothing. He pays nothing. He pays nothing, no fees. Okay, no fees. If you buy Facebook, you pay no fees. That's why the people, the richer people, they buy more stocks that are good, and they can make they can become millionaires or billionaires. But if you buy mutual funds, understand that you are going nowhere with your investment. This is just something I want to tell. And if you have a different opinion, you should tell me. Okay? So let's continue. Let me see what the guys are writing, and then we can continue. Chris says, yes, but not every stock you pick will be like Facebook. You can't really compare returns of an ETF to the returns of one stock. Yes. Why, Chris? I'm telling you this. Because if you buy stocks, the risk is higher, but the money is bigger. Now you go with ETFs and you go with mutual funds. First, because you don't want to learn how to trade or how to invest by yourself. And this is a problem, Chris. Okay? This is a problem for you and your life. Check, for example, your 401k if you have, or another investment. Who is making the money? Okay? The people who are making the money are the mutual fund managers and the companies that they make them. That's why we have thousands of ETFs, thousands of mutual funds. Understand that. If you don't understand this, you are with the consumer society. Chris, what does it mean, consumer society? You are consuming what the others are making. Those mutual funds managers, those ETFs, there are thousands, and each year you have more. They just advertise for them. And each year they come with another one. Oh, this is good one. This is better. This is better. But when you buy, you get a problem. Your investment doesn't grow that fast. This is the problem. Because you give your money to others to manage your money. If I tell you, as just an example, okay, Chris, just an example. Do you think that you can give your paycheck to someone else, and you ask him what you need, and he give you money each time you ask him? I go to buy this. I go to pay a bill, and he tries to control your money. Okay, you will never accept someone who controls your money, your paycheck, for example. So Why are you giving your money to mutual funds and ETFs? They control your money also. If the market is, let's say, is too bad and everything is going down, understand that you can't get rid of all this investment. This is what we are speaking here when I speak about the solutions. We have a real problem. If the stock market crash comes, those people who invest for the long run, those who get the big hit, not the traders. For example, for us, like swing traders or day traders, okay, if things go bad, we go short stocks, that's it. Each day we follow stocks that are going down and the whole market is going down, we are making money. But the investors are crying. Okay? They are crying because they see their investments going down. I give you an example right now to show how this is too bad. Okay, let's see what the other guys are saying, and then I explain an example. Prince said, Chris, fundamental matters to find out the type of stock like Apple, Facebook. Okay, Prince, for me, for example, I don't use fundamentals. I don't use it. Dr. Ted, Tom looks like it started in 2016 and close to the SPY. Let's say other information. Please, I will just try. The bid and the ask on the options are really wide. Even the actual stock bid and ask is example wide. It has a low expense ratio. The bid is not attractive. 100 bid is facts. When the market drops, okay. Please, Dr. Ted and Chris, we are going to shift right now. I just give you an example. So if you want to speak about other subjects, we let it later when we finish our presentation, because we are just beginning the subject. We didn't say that much. I do agree with you that there are a lot of bad funds out there. Lots of people want to make money for mirroring this. Chris, I'm asking you a question. Why you are following the people that they compete with this S&P 500? Why? If a bad year, the S&P 500 is going down, are you going to compare yourself to it? This is just the market standard that the people see, but it is not a real market. Your real market is where you are. Okay? Let's say your industry that you are in, you buy some stocks in the same industry or the same sector. It's going up. But the other industries are going down. So the market is different. So let's move on, please, and stop speaking about this from this ETF. Now, let me give you an example of what will happen for those people who have who have like a 401k. Just an example, okay? So please don't write in the chat room anything. See, Baba, we are not going to speak about another thing. Let's continue our subject of today, because right now we are in 1 hour and we didn't just begin the thing. Okay, so let's go to the explanation. Okay, I give you an example. Okay, now this example is for all the people who have, let's say, an example of 401k. 401k is an investment plan. Some people, they say it's retirement. Yes, because they don't let you get your money into retirement, but it is not a retirement plan in the sense that you will be making money from it. Okay, retirement plan. Now, I say it's an investment plan. I will show you why. Let's say, okay, you begin in 1990. Your 401k is going up, okay? And now 2018, let's say you have 500k in your 401k. 401k, for those who work in some companies, they give 401k. There are some other similar investment plan, okay? You should, for teachers, they have another name, but for almost all retail and the other, they have what we call 401k. Now, 1990, okay? So for 28 years, you have been adding money to your 401k. Now, let's say in 2008, this is just an example, okay? Let's say there is a crash and you lose 50% of your money and it becomes 250,000. This is just an example. Like what did happen in 2008. This is what happened in 2008. This scenario, it could happen now or in the future, and we can lose 50% or 40 or 60 or 100, whatever it is. So what does it mean here? From 500k to 250k, it means you have lost 14 years of putting money. 14 years of your life putting money is taken by whom? By Wall Street guys. Wall Street guys, they can take your money at any time they like if you are an investor. Okay? Now, why they take your money? Okay? They take your money when there is a crash. The mutual fund who are selling very heavily, they don't care about what the investors are or what they're doing. They say it's the market, but it is themselves who are selling. Because the government right now, I think the SEC has given rules not to sell that much from what they own. It means from what they have. Because mutual fund managers, they own the whole market. The problem is that when the stock market is going down and you want to take this 500,000 out, okay? You can't. You can't take it out because of the rules, because it is a retirement plan. You should be like 59 and 6 months in order to take your money out. And when you take money out, what's the problem? You will have to pay, let's say before you reach 59, 60, you will have to pay the tax, which is so high because they will take all this money, put it in your as an income, and you should pay, let's say 25 or 32 or 35%, depending on how much money you have, and plus this one. So this is, I just show you how destructive is when you put your investment and you can't take your money. For example, a trader who has $500,000, he can take all his money in few minutes. He just sell what he has and he is out of the market. So this is how the difference between investors and traders. Traders that have more choices than investors. Okay? This is just an example to show you. 401k, they are investors like us. All the people who work in having jobs, they might have. So here we have traders. Now traders, they have freedom. This is what we like. We like our freedom. We don't want to put money and someone else stop us from taking the money. Here you have no freedom at all to take your money. No freedom. Okay? Especially when you are less than 59 and 6 months. Plus, they are put in most of the time in mutual funds. They have fees. ETFs, they have fees. Okay? So all this stuff is very, very bad for investors. Now, if there is a crash, they get hurt more than traders. A trader can, for example, short sell a stock. Short sell. Or he can short sell an ETF also. ETF, for example, I give you an example. Have you seen, for example, energy sector? Energy sector when it was going down. So if you bought this ETF and you short it, it's like a stock. If you short it for 1 year or 2, you will be making a lot of money from it. Although these guys here, they are having problems from this ETF because it's going down. Because all they go long. Now, the freedom in traders is that you can go long and you can go short, selling short, and you can go long. That's why traders have more freedom than investors like 401k or any other form of this thing, or banks that do investment. Always we have fees, we have a lot of stuff. Okay? Now, let's go and try to see what the people are saying. Okay, Baba Stock said, is Apple still control large portion of the industry as you mentioned in the video? And how about next earnings? No, see, earnings, it just show what the company is doing. Even sometimes it's doing good and the stock doesn't move up or down. So it depends on the traders, what they think and what's their opinion. It has nothing to do with Facebook, like a company making money. So Facebook is always making money from 2012. It is making money because those guys who own Facebook, they get bonuses, they get money. The workers, they work for Facebook, they get money. So they are always making a lot of money, millions of dollars for each guy of these guys they are making for Facebook. So it's you that you own a share. You are not like Facebook executives. Understand that. So Nadia said, in case of a market crash, you can switch your mutual funds to money market or gigs funds in order to avoid losses in in 401k. Nadia, I will try just to explain to you. Okay, so expect it will be a few days later. Now it could be any day. It can begin at any day, so there is no problem with that. So don't worry about when it happens. It's for investors who are scared. Okay. So Nadia is giving us a solution. It says, in case of a stock market crash, you can switch your mutual funds to money market or gigs funds in order to avoid losses in forex. Now, losses, you will be having them before you sell. You will having them because when the stocks and mutual funds begin to sell, you should sell in order to do money market. Now, when everybody is selling, the market goes so quickly. I will, Nadia, please give me 5 minutes. I will explain to you what will happen when mutual funds, they will sell before you go to money markets. Okay, so let's just give you an example. Excuse me for all this mess. Okay, now this is, I will show you. Now this is the market for many years, is going up. Okay, let's say it is the Dow Jones. It's going up, it's excellent. And here there is the crash. Now, if we speak about the mutual funds, since the mutual funds, they have a lot of money in the market, mutual funds, what they do in order to exit the market, what they do, sell stocks. Now, when they sell stocks heavily, they are not selling like 1 million or 2 million shares. They can sell, for example, 1 billion shares in a day, or 2 or 5 or 6, depending. And all the mutual funds, it is the whole market. Now, when they sell, okay, who comes to help them is the hedge funds who doing hedge funds and day traders. What they do, hedge funds managers and traders, what they do, when they see the market is going down, what they do, they sell short also, selling short more stocks. Okay, so that's why it will be very, very quick. Now, mutual funds are selling, hedge funds are shorting stocks with day traders. What will happen? The market will lose a lot of 10%, 20%, 30%. You will never know how much it loses in few days or few weeks. So the mutual funds, until they sell everything they have, for those people who ask mutual fund, there are what we call government, the SEC rules. You can't, the mutual fund can't sell everything. This is the rules. You think it's very easy. When you go to your account into a 401k and you want to change to money markets, for example, okay, let's say this is example I give you. You think it's very easy? It's not easy. Okay, so let's say here 401k, and okay, we have selling. Okay, so when the mutual fund who are here, I will try just to make sure you understand that it is not as you think. Sometimes they will block you. Okay, mutual funds are selling, but there are rules by the SEC. It means by the government, by the Security Exchange. Let's say these rules, I don't know these rules, okay? So you should go and search, because this information, it's not available like this. Let's say the government asks the mutual fund to sell only 20% of what they owe, or what they have. The 80% you can't sell them. This is a rule. Just say it's a rule of the SEC. Okay? Now, if 20% of is sold in this mutual fund, you go to your account. You go to your account and you want to sell. They say no, you can't. Okay? You don't have the choice. You should stay with the guys that are with the 80%, and this 80%, if it goes so bad, you will lose 30% or 40% or 50% of your money because you can't sell. So understand, Nadia, that it's not you are not free to do whatever you want with your 401k. You can't, because there are rules, and these rules you can't change them in 1 minute. Do you know why they ask the mutual funds not to sell everything they have? Because here I show you something that you don't know. If, let's say, the mutual funds, they have 60% of the whole market. If they sell all their stocks, so the market will go down 60%. And since the other people are buying, it can go to 80% or 90%. Okay? It goes down, that's it. Like what did happen from 1386 in 1929, they go to $40. You see how much? So my explanation is it's not easy when you are in an investment plan that it is blocked, because 401k you have signed papers, okay? You have signed papers that you are not going to take your money, and they have rules. So these rules you can't change them like this. Okay, so Nadia, did you get my message? You are not free. Okay, you are not free to do whatever you want at any time you want. When there is trouble in the market, everything is blocked. This is what happened in 1929. People, they want to take their money, they don't let them take their money because because it was chaos in the market. Okay, so it's not easy. Thank you. Hello, Minyapan Mini, how are you? In 2008, there was no one buying the one side. The bid ask were really wide too. If there is a lot of selling or a lot of buying, the bid and ask will be tight because there is a lot of activity. Yes, you know, it's not only day trading. You can do whatever you want in certain trouble days. So yes, I am very good. You come late, Minyapan, as always. We have 1 hour 17. Hope you stay with us for some time. Okay, so and let's continue now our discussion about the solutions. Okay, now Baba, he said, Kareem, are you scaring traders? No, it's the opposite. It's the opposite. Have you seen me telling you that you are free to short sell stocks, to go long? You are free to do what you want, and you are not trapped into the mutual fund and the other stuff, and the 401k. And if you put all your money there, and then you will have trouble. It's the opposite what I'm saying. I'm saying that the traders, or if you are an investor by yourself, you can decide to sell at any time without being obliged to follow anyone. Or if you have all your money in 401k, this is what happened. But I'm not speaking. Yes, buy and buy and buy. Okay, buy on the bottom, as they say, and then when you buy, the stock will go more down, more down, more down, and you lose all your money. Okay, now let's go to solutions right now, because we are in 1 hour 18 minutes and we have not spoken about solutions. Now, let me give you some information about what the people do. So in terms of solutions, okay, an example. Solutions. So some people, let's say number one. Now here I'm speaking only about what the people do when the stock market is beginning to go down. They do what you call hedging. This is not the crash yet, but they do hedging. Hedging, it means if you own a lot of stocks and you don't want to exit right away, you can use puts option contracts to hedge. It means here your investment is going down, and if you buy puts, okay, you will be making money. This is the first solution that the people do, and even in mutual funds, even in 401k, and they buy puts in order to control, not to lose that much. Okay, so this is called hedging. Second, some people, they sell everything right away when they see that the market is beginning to become trouble. They sell everything, and as she said, as Nadia said, you can put this money markets as an example, is an example. Now you can also for those who are in the market, you can use bonds also, which is what the people do in 401k. They buy mutual funds and they buy bonds. It means they give you, let's say they give you 5% of these bonds, like interest rate, and you are lending money to other people, or to government, or to cities, or to the counties, or whatever you do this. There are hundreds of bonds types, and in terms 6 months, 1 year, 5 years, 10 years. It depends on what you choose. So we have hedging. It means buying puts. But understand that any solution that we are going to speak, there are some good and bad things. Now, so this is another thing that I will tell you, which is to sell short, okay, as day trading or swing trading. It means when you see something attractive, if you are doing day trading or you are doing swing trading for some stocks, okay, you try just to sell short. It means you borrow money, you borrow shares, that you are not borrowing money, you are borrowing shares, and then if they go down, then you buy them back. And this, for example, you can find it in training, especially day trading, training level 11 in my thing, how to sell short a stock. This for you guys, those who are interested. Now, number 4, you can short the whole market. Okay, short the whole market using ETF. This you can find it in training. I will explain a little bit later. Training level 18, I think, which is how to short the whole market. Okay, this is just an example. Now 5, okay, so you can short the whole market, you can sell short, you can sell everything, and you put money markets. But especially when you are in 401k, this will be a very for 401k. Just to give you something, you can change your selection, okay, by, let's say, by adding more bonds to your account and less stocks if you see that things go bad. But you do it at the beginning, okay. You don't let the stock 1 year going so down and then you can change. This will never will never help you. And understand, there is something that I will tell you about bonds and this. When the stock market crash, okay, or crashes, so the bonds go up. So you see, it's very good for some people, because the bonds will go up. It means if the stock market is going up, the bonds will go down. That's why you see in 2008 and afterwards, the bonds, no one buys them, because let's say 2%, for example, and you go to S&P 500, you can get, for example, let's say 10% each year. So you see that things will change. Now, I put all this stuff, and I will see your questions, and then we can go back to them and we explain into more details. Okay, I just put this. Maybe you guys, you have other solutions you can tell me about, and then we can speak. Now, Munyapan said, that's why it's good to day trade. Okay, doing good, sir. Here, Karim, are you scaling trading? Okay, bye bye. Okay, Baba say, can I trade ETF for industry, and which is in good? I heard SPRD. Can I trade ETF for industry? Yes, Baba. You can check ETFs for whatever industry you like, and it's like a stock. You can buy, but please don't give Baba. Don't give names of ETFs and other stuff, because the people here, some are new, some they don't know, and they just take what you write and they go to buy. We are not here to give what you buy, what you sell, okay? So don't give names. But you are free. But it's not the ETF that you are looking for. It is how do you trade. This is the most important thing. You can trade the ETF, you can trade stock, you can trade it whatever you want. But the problem is not the ETF. The problem, do you know how to trade, yes or no? When you know how to trade, you can do whatever you like. But when you don't know how to select this ETF or stocks, it's the same problem. Okay? Nadu, buy precious metals, gold, stocks, gold. Yes, this I didn't mention about physical. I'm speaking here about physical gold. Okay, let's go, and I give you. I put this because I know it, but I didn't put it. There are a lot of stuff that I forgot. So let's go and put the other thing. Okay. So let's take this one, solutions, and let's take this one and put it a little up. Okay. Okay. So yes, number 6. Okay, let's take this red colors and I put 6. It means buy physical gold or silver. This is some people they buy a lot of gold and they put it in banks, because you know physical gold, it means most of the time it has its value, even it doesn't disappear. For example, if you buy like 1 ounce of gold, it stay the whole life. 1 ounce of gold, it doesn't change. Okay, and the value changes a little bit up or down, but it's not big deal. This is when things go worse. Okay, so let's now speak about some bad things. Understand that when you do hedging, the put options, if the market, let's say the market was going up it's going down, you are making money for the options. But if the market is going up, you lose all this money of the options. So try to be careful that this is not a game that you have no risk. There is always risk in what you do in the market, and whatever you do, you will have problems. If you are not with the trend, either up or down, you will have problems. And another problem with these put options is that you don't know how many months you stay. Is it 1 month, 2 months, 6 months, 1 year? You will never know. Let's say you buy, let's say you think that the market is going down, and you think the market will go 1 year. Let's say the market has gone only 1 month, not 1 year. Understand that the market, when it's going up, you lose a lot of money from these options because you lose time, you lose a lot of things. So it's a very tricky thing. Now, there are some people who sell everything. For example, they have a very long investments, and they see the market is doing so bad, so they decide to sell everything, money markets or bonds, so they can get 2% or 5%. That's what they want, which is okay. For if the market is losing a lot of money, these guys will be happy because they don't lose as much, and they can make some money. Other people, they can sell short, day trading or swing trading. I have a word about swing trading. Be careful. Never swing trade penny stocks. I tell many times, but a lot of people, they don't know what's the risk. So if you go to, for example, to my training about training level 11, it explains this risk to sell short. Penny stocks are very small. If you, for example, you see it's $1 and it's going down to 90 cents today, and you want to short it and you want to hold for tomorrow, and then from 90 cents tomorrow you find it $5. Here you are going to go bankrupt, okay? Because when you buy at 90 cents, tomorrow is $5. There is some fool or someone who is buying everything for this penny stock. So you lose your money, and you lose 4 times your money. And the broker will call you, and you should put all this money back. And that's why some people, they go bankrupt because they don't know what they're doing. That's why when you sell short, it's better to do it in day trading, and you should have a good broker. And you should, when you begin trading or shorting stocks, you just sell short few shares only, just to get the feeling of selling short. Don't get into big positions. Okay? For all you guys who want to do day trading in selling short, to know the techniques, to know the ways, when to sell, when to buy back your shares, or to know all the risks, please check training level 11. Now, short the whole market using ETF. There is another way. When the market is going down, you try to select indexes, like indexes or industries or sectors, and find the ETFs, and you can short them without selling short. This is different. These ETFs, when the index is going down, this ETF is going up, and you can make money. If you are interested, go and see training level 18, how to short the whole market, and it will give you all the information. Now, 401k, change your selection by adding more bonds to your accounts. It means, let's say you have 90% stocks, 10% you have bonds. Now you just change this percentage. Okay? You go to your account and you change this percentage as you like. No one will stop you from doing this thing. Okay? because in terms of trouble, if you go to bonds, it will be better in general, because you don't lose that much from your account, because all your stocks are going long. Okay, so if things happen and the stock market goes down, so you will be losing all the percentage, and depends on the mutual funds. Sometimes they are in bad sectors and they get hard, so you will lose a lot. Now, buy physical gold or silver, you can do that because the value doesn't change that much, okay, through years. And you understand that people, they don't go to do physical gold as an investment for the long run, because it doesn't grow that much. Now, I will give you an example to understand this, okay? Let's say, just an example. Let's say you have Facebook shares, okay, and gold, like, let's say 1 ounce, okay. Let's say 1 ounce is $1,200, okay. Let's say we begin from 2012. I don't know the exact price, but I'm just showing you, okay. Let's say 1,200 now, and Facebook now $180, just an example, okay, an example. You go back to, let's say 2012. Let's say here the stock was $20, just an example, okay, $20. Now let's say the gold was $400 in 2012. I don't know exactly, but I just guess it is 400. Now here you get 300% of your money, but here how much you get? You get 900%. Now the reason for that, the share becomes bigger and bigger and bigger and bigger, because it can become bigger. But 1 ounce of gold, it stays 1 ounce of gold. Even if you stay 1,000 years, it will be the same. 1,000 years, 1 ounce is 1 ounce. But one share, it is 20. It can go to 180. It can go to 1,000. Okay? It can go to 5,000 a share. But the ounce, even it goes higher and higher, by history, it is not a competitor to a share, because a share moves faster because of the company. Okay? The good thing about gold is that if the company goes back and goes bad and go bankruptcy, your gold doesn't go bankrupt, or you still have 1 ounce of gold, whatever is the price. So this is the good thing, the bad thing. Now, I ask you the question, why, for example, Warren Buffett doesn't like gold? Because he says the 1 ounce, it stays 1 ounce. But let's give you an example of a company, okay? A company, for example, the assets of the company. Now let's say Walmart. Now Walmart, now it has around 12,000 stores all over the world and in America. Okay? Now it begins with 1 store. So in terms of in 1 store, let's say if you buy gold, you have 1 ounce of gold. 1 ounce of gold. So this 1 ounce of gold, it's like I think 28 grams or something like that. It doesn't change. But Walmart stores, from 1 store, it goes to 12,000 stores. It means in terms of assets, when you buy shares, The assets can be so big. That's why Warren Buffett, he doesn't buy gold. He said that I don't buy gold because it doesn't move. It doesn't change. That's why he likes stores. He likes the stores, insurance or banks or whatever, but he likes, I'm not saying that Warren Buffett, he buys Walmart. No, I'm saying that he buys, for example, Coca-Cola, for example, or Geico, okay? And the stores are going more and more and more. So the company is making more and more and more money, but the gold is static. It doesn't change. So let's finish with this. Let's go to our guys and we try to see what they are saying. Okay. As we spoke about the prices. Now let's see. MC4Ps, hello. You are coming late, but there's no problem. Hello, Kareem. If someone is proficient in one market, can he trade all the markets? Yes. Why not? If your techniques is based on price, like my techniques are based on price, you can do any market. Okay, any market you can do it because you rely on price. You don't rely on the company information or something like that. Okay, so Dr. Ted said my broker, Interactive Brokers, would just liquidate positions. There will be no cost, no call. Yes, yes. Sometimes, especially when you have. But what if Dr. Ted, try to understand. What if the news comes before the market or after the market? I don't think that your broker will liquidate your positions because it's your trade. For me, I don't like that he touched my trade. So I don't like that my broker interferes in my business. I am good or I am bad, it's my problem. Okay? But there are some people who don't know what they are doing. They can do especially when they use margin account. If you take the money of your broker, yes, he has the right to do something because you are doing something foolish. You don't understand your risk and you can do a lot of problems. Yes, Dr. Ted, you are right if it is the case, the margin account. But in cash account, your broker has no right to touch your money or your positions. Nadia said, what about buying mining companies, stocks, or ETF, gold, sexes, or company? Okay, try to understand, Nadia, that if you are buying stocks, mining stocks in gold, and understand that the whole market is going down. But let's, in the sake of since you ask. Let's go to the chart and check, okay? Let's go to the chart and check these gold stocks for you guys, for Nadia and for the other guys. Okay, let's go. Let's go to the mining sector. Metal and mining. Let's see. This is a yearly. Okay. Check now. This is 2011. No. Let's say this is 2008. So, Nadia, do you see how much copper has gone down? This is copper, okay? This is copper price, the index, how from $1,491 or $106,445, it goes to 346. So you see that? It's about 70% lost in that year in copper. Let's go to another thing. Non-metallic mining, they lost too much also. Industrial metals and minerals, they lost also. Steel and iron, you can see this here. From 1,300, it goes to 242. So you are losing almost 85% or so of your money. Aluminium, it goes from 805 to 122. So you are losing a lot of money. Gold, so you don't lost that much, but it was 683. It goes to 197. What does it mean? It means it's nearly 47%. 40% in 2008. And you see that it goes to 795. It goes now to 300 through these years, you see. So this is the gold thing, the gold index. And if you want silver, it's the same thing. Now let's go to stocks in that section, and we see. Now 2000. This stock has not been in 2008 because it begins in 2009. But see 2000, for example, 13. See how it goes from 167 to 116. Okay, you see this? Yes, here is 2008. So your idea to go from stocks, general stocks, to go to gold and thing, this doesn't work. As you can see, this company in aluminium, it was $79. It goes to $15. But the other years, it goes the opposite. Another one is called gold. It's a stock. Okay, where is 2000? Yes, 2008 is going up. This thing. So just I'm showing you some stuff, but you can see 2008 was bad for everything. Okay, so I don't want to stay to use. Okay, so as you can so you say not copper companies. The copper is correlated to the stock market. It is used in industries. No. Forget about copper, that it is used by companies. But the price of copper is going down. This is what interests us. There are companies that they mine copper. This is what we are interested in. You buy shares of this company, and in 2008 they lose money. So you will be losing money because the value of copper goes down. So these companies go down because of the bad year. Okay? So understand that this thing is so difficult. It's not easy, and whatever solution you have, it has its own advantages and disadvantages. But I'm telling you something different right now. Let's go, and I speak to you about Jesse Livermore. If you heard about this guy, who is the biggest traders in the United States in the beginning of the 20th century. So let's go to the chart again, to the explanation. I will explain to you something. Okay. What's this? Okay, just to give you an idea. Okay, So just Livermore, I don't know if I pronounce his name correctly, is he was called the plunge boy. Okay, this is, I was fascinated. I read his books, and I read a lot of books about him when I was searching for my solutions to my problems. So just Livermore, he's called the plunge boy, because he's just doing a lot of short selling. He sells short a lot. Okay, stocks. Now, during the crash of 2007, no, not 2000. Okay, I'm sorry. 1907. Okay, 1907, there is a crash, and 1929, this guy has made, they say, I think it's like 100 million or more in this at that time. I don't know it's 100 million or more or less, but this guy, where we have, after the 1929, we have the Great Depression. Okay, the Great Depression, where millions of people, they lose their jobs. Okay, lose jobs, and they lose their wealth. This guy is having a fortune to make millions of dollars. Where the people are crying, he was laughing. Okay, he was laughing where the people are crying. What did he do? In 2009, when he see that there are many years, the stock market is going so good in many years like this, going so good, he speculated that there is a crash, like in 1907. It's the same thing. But here he was going up. When there is a problem with the company, he shorted. But in 1929, he short almost all the stocks that he had, because he use also margin, and he has a lot of money, because he is one of the best successful traders in the world. So in 1929, he always short, and he short heavily. Whatever banks give his money, he tries to short. At that time, it was easy. It was easy to have, like, let's say 100K from the bank as a loan. Okay, it was so easy. It's not like now. Now it's very, very difficult. The margin account is very difficult now. Let's say if you have 10K, they can give you 10K also, but they can't give you 100K just like this. Okay, so you should have assets, homes or thing. Now, why I give you this example? Because I see that some people are making money even in the worst crash. So, like Jesse Livermore, or there is another guy who is also, but this guy is doing a lot of stuff right now. Maybe some of you know his name. He is called George Soros. Okay. In one trade, they say he get $10 billion in one trade, and this is, I think, in forex. Okay, he bet against banks, I think in Asia, and the thing is, he bet and he succeeded, and he get $10 billion in that trade. So you see how people, they can make a lot of money by trading. And those people who said that only investors, they can make money, this is not true. Okay, so investors, they can make money, yes, in the long run, but they can lose it also. The proof of that is that the crash of 1929, okay, the market from 386, it goes to 40. See how much the people have lost. Okay, So let's say 5 and 5, 10. Let's say you lost 90% of your wealth. Let's say this is your 401k. What did happen? What did happen if you have a crash and you lose 90% of your money? Like what did happen in the thing. This is a big deal. The people, they don't think a lot about this because they just say, okay, we just invest, we forgot about it. But things in life, it's not the same as you might think, and there is no hope in the market. There is no hope. Either you know or you don't know, and you should act fast before you lose everything. Okay? Yes. As Dr. Ted said, he made his money against the British pound. Yes. And I think it's have a relation with Asia, also with the banks. And oh, you said Baba Stock said you say this man is so scary. Yes. Because see, he is playing with other people's money. It's not his money. Okay, he was a hedge fund, so he plays with other people's money, and he can make money, he can lose, but he is always winner because he's always making money. Baba Stock said Carl E. Cowell made 700 million since Trump elected. Yes, you can. You know, you can make money from things changing in the stock market. Are we in the top of the market? Now, are we in the top of the market? We are, but we don't know when the crash comes. Now, for us, like swing traders, we don't worry a lot. We put stop loss. If there is something wrong, we get exit and we have our money in our accounts. And then we see the market in few days and we see, is it a small correction or is it a crash that will continue? And we can do short selling, we can do day trading, we can do shorting the whole market. We can do a lot of things because we are free to do what we want. But you, if you are an investor, you have a lot of money in the market and you buy stocks or ETFs or mutual funds. It will be a very dangerous thing what you do, and your decisions will be very, very hard to do, not like traders. Now, Baba Stock said, I am saying that market will never crash. Dow will go to 1 million points. Baba Stock, why you are saying that? It means this is the fools of the market, the crowd. They think because it goes up, it continues. There is nothing. Okay? The market is like a human being. It can go good. He can walk. He can run. But sometimes he falls, and sometimes he dies. So the market is nothing changed because we are human. We know just buy it up and manage the risk reward. Yes, you can just do that. Yes. Yes, no one knows. See, don't predict about the market. This is what I have understood from my experience and from seeing the history. There is no guarantee whatsoever. Small correction, big correction, a crash, you will see it. You will see it when you are in. But now you can see nothing. You see that stock is going good, especially in 2019. It is so good. So we continue following the good things. And if things happen, we try to change things. He says we will never fall. Everyone should just drink the Kool-Aid. Yes, yes. We drink Kool-Aid and we sleep and we dream about good dreams. Yes, this is okay. Okay. So as I told you, in stock market, when there is a crash, who will benefit? So day traders benefit, and hedge funds benefit. And those who lose a lot is mutual funds and the public in general. This is just a general idea that I have, okay? Because if the market is going down, almost all the stocks are going down, it will be global. The whole USA stock market will be collapsing. It's not only a sector or. And after the market collapse, what will happen? Because the stock market gives you the news before it happened. We are in a good thing because the market is doing good these years. From 2008 right now, it's doing good. But if the market is going down, after it, there will be a lot of job loss, a lot of problems in the companies. Some companies, they go bankrupt, and it will happen bad things after the crash. Okay? Baba Stock said how to deal with seasonal stocks. So for me, I don't understand this seasonal or not seasonal. It means cyclical, but they don't. The cyclical stocks, you will never know where they begin and where they go down. So we can know because we follow trends. Wherever anything that in the market moves, we can check that, and we can get those industries or those stocks that are just beginning the trend, either uptrend or downtrend. Okay, if you use just my techniques by the search, you can know each day you see those stocks or those ETFs or whatever. Yes, after falling, we get a V-shape recovery. But this V recovery, you will never know how many years we recover. For example, in 1929, the Dow Jones was $386. It goes to $40 in 1932. From $40 to go to $386, it goes until 1954. Okay? So what does it mean? 1954, you should wait all that. Suppose that someone is 60 or 70 and he lost all his money. He can stand 20 or 30 years waiting until the stock market goes up. There are some stocks, they collapse and they go bankrupt. It means companies, they go bankrupt. So it's not always a good thing. Okay? How to know the bull traps? Now, there are techniques that I have in my training that shows you when the stock is going up, when it will collapse, and you have confirmation when. There are techniques that you should use. It's not only by watching TV and by watching news you can know. Those, they will never give you the right answer because they don't rely on the price. Because they go against you. They say to you buy and hold, where you see in the stock market that the market is crashing. They ask you to buy more and then they are selling. How do you know what they are doing? So the news in the stock market, it is so different from what we have. Dr. Ted said you need to look at the sector rotations for the seasonal stocks. Yes, this is what I teach in training level 3, which we call the industry rotation. But you should have techniques to know when it goes down. Yes, this is what we do. Do you know the 3-step and 5-step retracements? No, I don't use what you know. What you know is the people. They publish in books. I don't use their techniques. I have my own techniques that I use, and they are more efficient and effective than those retracements they use. Okay, so it's totally different. What I teach is totally different. What you know or what you have read in books. How should we as trader deal with breakaway gap? If you are in and you have, let's say, a gap up, you are making money. If you have a gap down, you are losing money. So what should they do? What should they tell you? something happen that you have no control on. Okay, so this is the risk. Either you stay or you don't stay. This is, you should know by itself. Okay, and there are techniques to know if this gap up will continue, or if the stock will stop in when we have a gap down, and it will never gap down more into a what we call a downtrend. So there are techniques. Always we have techniques to know these things. That's why when we have confirmations, these confirmations, we see them by looking at the price. We don't look at the company fundamentals or the gurus online or TV people or whatsoever. Okay, so we will never do that. So our thing is to know everything by ourselves. We are not following anyone else. Baba said, why would you show companies that from Colombia like that when you show in your video? Well, which Colombia video? I don't know what you are talking about. Colombia stock? Which stock? No, NBC or Bloomberg, they look so beautiful. Yes. Dr. Ted, yes. It means those people, they are speaking about the past, and they give us recommendations to the people, and the people, they follow them, and then when they lose their money, it's over, because they just tell you what to do. It means if you don't know what you are doing, this is yes, I know, Dr. Ted, you look a good guy. You don't look yes, you look the pretty faces, either man or woman. Okay, they know everything about the future. They know everything about the past. They are, the gods of TV, and the people, they think they trust them because they think they know the future, and this is a problem. Okay. Yes, Baba, you speak about something. You say you show in the video a Colombia stock. Please tell me what's this Colombia stock first, and then we can go to volume, because you are asking too many questions, and you should ask a question, let me answer, and then we go to... the EC stock? Okay. Now, this stock that I show in YouTube, it's just I show you how stocks can go so good. It is if it is Colombia or it is USA or Canada, I don't care about the origin. It is here in our stock market, because for me, I buy what is in our stock market. I don't buy things that are not listed in the stock market, like Nasdaq, NYSE, and the American stock market. So I buy the 24,000 stocks that are in the USA. So whatever stock is. Yes. I have a lot of stocks like these, EC and the other stock. But in my subscription, I show them a lot of my that I am in or that I am trading, and to just know how to follow the stock, how to stay longer, and there are techniques to do that. And if you have a winner, you should stay with it until it stops. And I have made live videos for 5 months and 2 weeks with Osur. I put it in YouTube. You can check it. But I didn't explain anything about what I do. All the explanation, 30 videos, I put them in the subscription. Okay, so in order that the guys that I pay money, they have more information about how do I do the theory to practice. Because a lot of people, they talk, but they don't show what is inside for true. For me, I want to show you things that are real in the market, when I buy it, why I buy it, how I follow it, when I want to exit, how I exit, and why. So all these questions reasons and the other stuff, techniques, I show live. It means I show them live for you in order to do the same as me. If you do the same, you will be making money as anyone else. And almost all professional traders, they do the same techniques. They vary a little bit, but it's the same basics. That's why they make money. Those who don't make money, they are doing other techniques that are mixed up with day trading, swing trading, investing, and they are confused because they don't know what they are doing. Okay, so that's the thing. That's why I told you, watching a lot of TV, if you want entertainment, go and watch a movie. Okay, go have a trip, have a party. This is entertainment. But when you put your money into the stock market, this is not entertainment. No one comes to you and say, buy this, sell this, hold this, like those analysts that are on TV. So if you follow them, understand that you are heading to a catastrophe. Okay? You should always take responsibility and trade by yourself. Baba Stock said, don't you think with this cryptocurrency that we never see big trouble in stock market? No, cryptocurrency, it's another thing. It's a bubble and it has an end. And you see Bitcoin, it was 21,000, now it's 11,000, or I don't know where it goes right now. So it depends what you are doing in the market. The stock market, yes, it can go like the cryptocurrency and can go down at any moment, at any day, because they will never tell you. Those guys who hold the market, which are mutual funds, they do stuff by themselves and they hit the market because they don't lose any money. It is the investors who lose money, not them. So those managers, those companies are making thousands of mutual funds and ETFs. Each year we have a new funds, a new mutual funds. Why they are putting more and more? It's just a game. You put an ETF, you give it a name, put some stocks in it, and that's it. And put an advertisement, people they buy, and you are making money from it. Okay? So Baba Stock said, if EPS go high, will it transform in the stock price? Oh, okay. Baba Stock, do you understand the difference between EPS, earning per share, for the company and for the stock market? It is totally different. Hope you understand what does it mean, EPS. EPS, they are thinking about the company itself and how much it earns. It has no relation with the stock market and the stock share. Okay? It has no relation. Let's say Facebook has made 20 billion, just an example, in this quarter. Does this 20 billion goes to shareholders of you and me if you own Facebook? No. The earnings, they stay with the company and they give it to their executives. I will So Dr. Ted said, if EPS is higher and the revenue drops, some might feel that it is a good or bad. And if the CEO says something wrong, it could tank. Yes, it's all. But understand, depends upon the trader feel. But I will give me, please, you guys, Dr. Ted and Baba Stock, give me 5 minutes. I will show you something about the company and in diagram, and I will explain. This it could be a very good thing for you guys. Okay, let's explain. Okay, let's go. No, not this. Let's go and make another page free. Okay, yes. Okay, let's give you an example. Company, what you call earnings. Just an example, okay? And here is stock share price. I will just explain this, and when I explain, you will get the idea clear. Okay? Okay. Now, when they see EPS, what do they mean by EPS? Earning per share. I'll just write it for you guys who don't know what does it mean. Earnings per share. Now, what does it mean, earning per share? Okay, so let's say Facebook, this is just an example. Let's say they make $20 billion in this quarter. $20 billion. And let's say we have 20 billion shares. Okay, let's say I just give you an example. Okay, it could be false calculation, but I just give you an example. Let's say they say it is $1 per share. What does it mean? It means if you own a share of Facebook, for example, you will get $1 profit. But this is only virtual. It's not true in the stock market. Okay? This is virtual in the stock market, because stock market, let's say if you have 180 and there is the earning news, what makes the stock goes up like a gap up, or it goes like a gap down? What makes it? It is the traders. It has nothing to do with. It has nothing to do with the company earnings. Now, who takes this EPS? It's not us who are the traders. Traders, they don't take this because let's say Facebook doesn't give dividends, so we are not giving any money. So the traders, if they like the earnings, which is better than the analyst, we have a gap up. Let's say it was 170, it goes to 180. Or if it is bad, from 170, it can go to 160. This is just what the traders do about their feelings. Now, who takes the money earnings? This is what I am always speaking about, that the people, they don't understand. Okay? Now, who takes this money that this money that we speak about, which is $20 billion? Who takes this money? $20 billion. Now, they go to executives and to workers. Executives, the owners of the company, executives, and to the workers who are working there. They give them bonuses, although they don't own any stock here. They don't own stock share. They don't own Facebook. Although they work for Facebook, let's say they don't own. But the company, which is the head of the company, which is Mark Zuckerberg, they give them bonuses. They give them money from the earnings per share. They give them money. This money goes to the executives and to the workers, but not to the shareholders of Facebook. For example, I and you, if you buy Facebook, they give you nothing. Have you ever seen money coming to you by a check coming from Facebook when you buy Facebook? No, it doesn't give you nothing. So this is always virtual for the company, but it doesn't affect the stock market. Stock market, it is the news, it is the bull market, it is the bear market, it is what the people say that moves the market up or down. It has nothing to do with the company. Facebook is always making money from when it begins, even if it is even before it was an IPO. It has been making money. Who takes this money? The earnings are the executives and the workers. That's it. So stop thinking that Facebook, because you buy a stock, they will sell you a paycheck. If they give us earnings from the company, that will be so good. But this is not true. They will never give you a check. Although a worker has no shares, but he can get money because he is working for Facebook. Okay? This is just to make sure you understand this stuff, and don't ask again anyone else about this. And this is what I say to you. Yes, as Dr. Ted says, depends upon how the traders feel. This is in the stock market, but what the market is doing is something else. That's why you should always not confuse stock market with the company itself. That's why for me, I have never seen the fundamentals of Facebook or any other stock when I want to buy. Never. I have never seen what these guys are doing. For me, the best thing is the trend. Is the stock is going to a trend? Yes or no? I will make you just an example, because this is, I think, the last explanation. I will what consider pullback and how maximal can go to take a trade. Now this, I don't have percentage. I don't work with percentage. I work with techniques. Baba stock, if you want to go to understand this, you can for example go to training level 13, how to buy from the support line. This where you find the answer for you for this thing. Now for the explanation, I will just give you one last explanation, and then we will finish this session, because we are more than 2 hours. We are 2 hours 20. Okay, so for me, the most important thing that you should know is that this is the point where I buy a stock. This is the candlestick. The stock is going up, okay? And it stops. Then it's going down. Let's take this, because this I will put it in red to make sure you understand. Okay, so then the stock is going down into a downtrend. Let's say downtrend. So it is 20. Let's say it goes to 60. From 60, it goes to 15 right now. $15. So my techniques is to show you how and when to buy. How and when to buy. Now, where here you put your stop loss. Stop loss. Where you put it? There is calculation about that stop loss. Now the other this is the training that I do, and how to follow the trend. Trend is sometimes very difficult to follow. There are techniques that I use in order to follow and not to exit early. Let's say January 1st 2017, and here is July 1st 2017. 7 months. So I am following the stock for 7 months, and then it goes down. So I show you how to buy the stock and when, where to put stop loss, how to follow the trend, when to exit on time to take all this profit. Okay, this is to exit on time. Exit, it's like stop loss for exiting with profits, the exit point. All this I teach, and it needs practice. It needs months, many months of practice. You should do a lot of stocks. You should follow. You should ask me any question if you are in the subscription, and that's it. Okay. And for you guys, I put my website for all of you guys. It is in all in all my my videos. And here is my email. I will put it down for you guys. Okay, and anyone who wants to contact me or to have some questions about the training, you just send me an email and I will be happy to help you. Okay, so let's go back. Okay, so let's say here, okay, this is my website and my email for those of you guys. So what is the other Baba asks what index future, okay, and can political instability affect the stock? Yes, Baba stock, you can see political instability. Yes, as you have seen in Great Britain, the exit pre-exit in 2016 in June 24, when the stock market go down here in America, although it is international news, it doesn't affect us. But you see, some traders, they short the stock market and go down. Okay, how reform and tax will affect the market? It doesn't affect that much. The reforms, we don't know what reforms. Tax doesn't affect, because if you want less tax, you should invest for the long run, like more than 1 year. When you sell, you get 15%. You get 15%, but if you 15% is your tax if you are an investor. Okay, I just write it for you guys. More than 1 year, more than 1 year. This is for, okay, for investors. Baba said, if Trump die, is it panic for my portfolio? What if he stay alive to 200 years? Is your portfolio will be good for you, man? So we will never know what will happen in the stock market because of the news. If people hate him, the market might go up. Yes, you know, the stock market, you know, it's a feeling of the market. There are the doer of the market. They can change everything at any time. If them love him, no. So it depends. It depends what will happen in the stock market. Okay, so guys, thank you very much for watching. We have been into a good session. You have asked a lot of questions. I have answered almost all. Doctor said, but feelings can go up and down like November 8th of the election. Is it the big risk fishing from the bottom? Oh, no. Yes, you see, there is always risk, but I will give you an example. When I will give you an example. When Facebook was at that time, 1999, I made a video, and they say it's an opportunity to buy. At that time, no one knows me, but the problem is that I always buy and sell for trends. Okay, so these videos, you find them in my channel from 2012 until now. You will find almost all gap apps that I was in, even Twitter, Apple, and the other stocks. It means when I do a trade and it was an excellent trade, I publish it and I will show everything. Okay, so thank you all of you guys. Thank you, Wiseman. Thank you, Dr. Ted and Baba Stock. You have been asking a lot of questions, and Nadia and the other guys who have been asking questions. I will be doing always the same hour, which is 11 p.m. on Saturdays. And if you enjoy the session, please come back and try to check my training. And thank you very much for your participation and for your contribution, and good night.